All right, let's dive right in. Today, we're going to tackle a real conundrum in the aerospace world, General Electric. It's a fascinating story, really. We're going to try and figure out why this industrial giant is commanding such a high price, and what the data really tells us about where it's headed.
Now, just before we get started, I have to say this upfront. Everything we're about to discuss is for informational purposes. It's an analytical deep dive, not investment advice, okay? The goal here is just to peel back the layers on a really compelling business case and see what we can find.
So here's the number that catches everyone's eye right off the bat. GE is trading at roughly 40 times earnings. Now that's a steep price. And it immediately begs the question, right? What on earth is the market seeing that justifies paying such a premium for this business today?
Okay, so here's how we're going to break this down. First, we'll look at the simple explanation, the surface story about supply and demand. Then we're going to ask, well, is this for real? Is it permanent? After that, we'll dig into what GE itself is saying, its official story, and then compare that to what the hard data is telling us. Finally, we'll pull it all together and make the case for a real structural change.
All right, part one. Let's start with the surface story. This is the simple, easy-to-understand explanation for why GE's stock is flying so high.
At the heart of this is a classic, textbook economic situation, a massive supply and demand imbalance. I mean, think about it. Everyone wants to travel again, right? But the industry, it just can't build planes fast enough to keep up. It's a huge bottleneck.
So you've got this perfect storm, right? Travel demand is booming after the pandemic, but building new planes is slow going because of supply chain headaches. So what happens? Airlines have no choice. They have to keep their existing fleets in the air longer. And that is music to the ears of GE's aftermarket business, which, by the way, is incredibly profitable.
Okay, so that brings us to the million-dollar question. Is this just a temporary boost, a short-term windfall? Or is there something bigger, something more permanent happening here? This is really where the rubber meets the road in this analysis. And this really is the heart of the matter. Are we just seeing a cyclical boom that's going to fade away once the supply chain sorts itself out? Or has the fundamental business of GE actually changed for the better for the long haul? Because, the answer to that question changes everything when you think about that 40x multiple. We've all seen this movie before, haven't we? Remember the stay-at-home stocks during the pandemic? They shot up like a rocket and then, whoomp, came crashing back down. The trick is figuring out if GE is in that boat, or if this is something different, something durable. Okay, let's switch gears a bit. Let's look at what the company itself is telling the market. We're going to decode the official story from GE. And what you'll find is, well, it's pretty interesting just how conservative they're being. We have to understand, the current management team at GE, they have a track record. They've built a reputation for setting the bar low and then jumping right over it. It's a classic case of under-promising and over-delivering. And you need to keep that in the back of your mind as we look at their forecast.
So, take a look at this. This chart, based on some great research from Citi, really lays it bare. On the left, you see the historical trend for engine retirements. It's a nice, smooth line. But then, look at what GE's own forecast assumes. It's this massive hockey stick jump. They're basically saying that suddenly, overnight, twice as many of their most popular engines are going to be retired. It just doesn't square with history, does it?
So, the official story from the company includes this really aggressive retirement forecast. But let's be good analysts. Let's ignore the forecast for a second and look at the actual data. What does the real-world fleet of airplanes tell us?
And boom, here's the counter-narrative right here in this chart. This shows the age of all those CFM56 engines out there flying today. And just look at it. The bulk of the fleet is here, in the middle, in its prime. These are not old, clunky engines ready for the scrap heap. This fleet is young. A sudden mass retirement just doesn't seem to be in the cards.
And here's the takeaway from all that. What the data is screaming is that GE's aftermarket business, that incredibly profitable service revenue, is way more durable than even GE is letting on. We're not looking at a cliff edge here, we're looking at a long, steady, and very profitable road ahead.
So we've established that the aftermarket boom looks like it has legs. But there's more to this story. Let's look beyond just that supply/demand issue and talk about the deeper structural changes at the company. You see, it's not just one thing. There are a few key pillars holding up this thesis. For one, the competitive environment is just better. There are fewer big players. They've also locked in incredible pricing power with these long-term service contracts. Internally, there's been a real cultural shift toward efficiency.
And on top of all that, they're now a focused pure-play aerospace company, which is a huge deal.
So when you put it all together, the durable aftermarket, the improved competitive position, the pricing power, you start to understand why some very smart people are making some pretty audacious calls about GE's future. It's what allows an analyst to say something like this.
Which leaves us with one final, fascinating question to chew on. What happens when a company's official story seems overly cautious, but the underlying data paints a picture that's overwhelmingly positive? That gap, that disconnect between the narrative and the numbers, is what makes this whole situation so compelling to dig into.